Welcome to the Deep Dive, where we like to take these deep dives into all the topics you ask us about.
I'm right into the good stuff.
Yeah, and today we're diving headfirst into high-stakes finance with, the big dogs, the billionaire hedge fund managers.
Under the whales.
Yeah, exactly. The ones who can literally move markets with a single trade. And we got a request to look into Nvidia and Chipotle stock.
Interesting combo.
Right. It's like, what's going on here? And it turns out some major players have been selling off Nvidia and buying up Chipotle.
Yeah, that's turning some heads.
Definitely caught our attention. So we got to ask, what's the financial logic here? Because on one hand, we have Nvidia, the powerhouse behind the AI boom.
Powering everything.
Seriously, everything from self-driving cars to those AI art generators that are like blowing up the internet.
It's wild.
Yeah, and then on the other end, you've got Chipotle serving up, burritos and bowls.
Hey, I love a good burrito bowl.
Who doesn't?
Right.
But what's the deal? We're not just following the money here. We want to understand the why behind these decisions and hopefully uncover some insights that, you can actually use.
Absolutely. And I think a lot of it comes down to this idea of value versus hype. You see, Nvidia is undoubtedly a leader in the AI space, right? But even the most innovative companies can get a little, pricey.
So even though Nvidia is riding high on this AI wave, and they even did that stock split back in June to make their shares more accessible.
Which a lot of people saw as a good sign.
Right. Making it more affordable, so to speak. But are some investors maybe wondering if the price is actually justified at this point?
Yeah, and that's a really important question. The sources you shared, articles from places like The Motley Fool, they point out that while Nvidia is projected to see their earnings grow by something like 38% annually over the next 3 years.
That's huge.
It is. But some investors might still be a little hesitant about their current price-to-earnings ratio.
Okay, hold on. Break that down for me. What's a price-to-earnings ratio, and why should I even care?
It's basically a way to measure if a company's stock price is actually, in line with how much they're actually earning and how much they could potentially earn in the future.
Okay.
So think of it like this. Would you rather buy a used car with low mileage for, let's say, $10,000 or a similar car with high mileage, but it's going for $15,000?
Right. I see where you're going with this.
The PE ratio, it's like comparing the mileage, the growth potential of companies relative to their stock price.
Okay, that's a great analogy. I got to use that. So in Nvidia's case, even though they're set to grow, maybe their current price is already reflecting all that further success. It's like they're being graded on a super harsh curve.
That's a great way to put it. And this is where the logic behind the shift towards Chipotle starts to become a little clearer. They're not this flashy new tech giant, but they've quietly built a really strong brand in the fast casual restaurant scene.
And they also recently did a stock split. But what I find really interesting is this whole food with integrity thing they've got going on. Fresh ingredients, ethically sourced meat, no freezers or can openers in sight.
Right. And all of that, combined with their dedication to being super efficient in their operations and their really loyal customer base, translates into something investors love: impressive and consistent growth.
So if these investors are maybe cooling a bit on Nvidia, what's making them so bullish on a company like Chipotle?
It seems they might see Chipotle as more undervalued at this current moment. While their projected growth might not be as astronomical as Nvidia's, and remember, we're talking about two very different industries here, their current valuation might seem more attractive to some.
So it's like finding a hidden gem, a company with solid fundamentals and a history of success that's maybe temporarily flying under the radar.
Exactly. It's not always about chasing the highest growth rate, but finding value in companies with promising futures, even if they're not making the biggest headlines. And that's what makes these recent trades so fascinating. These hedge fund managers haven't completely abandoned Nvidia. They still hold positions, but their increased interest in Chipotle suggests they see a unique opportunity.
It's almost like they're saying, hey, while everyone's distracted by the shiny new toy, don't overlook this other solid opportunity over here.
Precisely. But before we get too far ahead of ourselves, let's take a closer look at each company's recent performance. What kind of numbers are we actually talking about here?
You read my mind. Let's start with Nvidia. What's driving their incredible growth?
Well, in their second quarter of fiscal 2025, Nvidia's revenue absolutely exploded.
Exploded. How much were we talking?
A staggering 122% increase compared to the same period last year.
122%. Okay, they're definitely doing something right. What's fueling that kind of growth?
It really comes down to the massive demand for their AI hardware, particularly for data centers. We're talking about those gigantic server farms that power all those AI applications everyone's using, and Nvidia's GPUs are the top dogs in that space.
So it's not just the cool AI tools we see, it's the behind-the-scenes tech that's really driving their success.
Exactly. And it's reflected in their earnings, too. They reported earnings of $0.68 per diluted share, which is a 152% jump from the same period last year.
Those are some seriously impressive numbers. Sounds like a dream come true for any CEO. But you mentioned earlier that some investors are a little hesitant about their current price, even with all this success.
Right, and that's where it gets interesting. You see, Nvidia's price-to-earnings ratio is currently sitting at around 222.
Okay, I'll be honest, that sounds like a made-up number.
Yeah.
What does that actually mean in the real world?
It means that investors are basically betting on some serious future growth to justify that price tag. It's like buying a brand new, unreleased phone for twice the price of the current model because you're convinced it's going to be unbelievably amazing.
That's a risky move. But hey, sometimes those risks pay off big time. So is Nvidia going to be that amazing new phone?
Well, they do have a new product launch coming up that has everyone buzzing. Their next-generation Blackwell GPU. They're expecting it to completely revolutionize AI processing power.
So I'm guessing the demand is probably through the roof.
You bet. Their orders are reportedly booked solid for the next 12 months, meaning if you placed an order today, you wouldn't actually see those GPUs until late 2025.
Wow. Talk about a monopoly on the market.
It's a pretty sweet spot to be in, but it also comes with pressure. Even with all this success and the hype around the new GPU, their current price-to-earnings ratio is something investors are definitely watching very, very closely.
It's like they're a victim of their own success, in a way.
In a way, yes. It's a good reminder that even the most promising companies can experience some wild swings in their stock prices.
So it's like a balancing act. On one hand, you have incredible growth, a dominant market position, and a super exciting new product coming soon. But on the other, there's the big question of whether Nvidia is priced at a point where investors are fully confident in its ability to keep this momentum going.
Precisely. It's a classic example of the constant push and pull we see in the market, and it highlights the importance of looking beyond the headlines and really understanding the factors driving a company's valuation.
Which brings us to Chipotle. Now, they might not be making headlines for some groundbreaking new tech, but they're quietly racking up some impressive wins of their own. What stood out to you from their recent performance?
Well, their second quarter earnings were nothing to sneeze at, let me tell you that.
Give me the numbers.
Their revenue jumped a healthy 18% to hit a cool $3 billion.
Not too shabby at all. What's the secret ingredient in their success?
Their dedication to running a tight ship, operationally speaking, is clearly paying off. Remember we talked about their food with integrity thing? Well, that seems to be a big hit with customers.
It's true. I've noticed their lines seem to move faster than ever these days, even when they're packed.
Exactly. It's all about efficiency. Plus, they've seen a significant increase in same-store sales, meaning people are not only coming back for more, they're also spending more money when they do.
So their commitment to quality and transparency seems to be paying off big time. But here's where it gets really interesting. Remember those hedge fund managers we talked about earlier, the ones buying up Chipotle stock?
I do, those savvy investors. What about them?
Well, they were buying it when the stock was actually trading at a higher price-to-earnings ratio than it is right now.
Now that's interesting. So even though Chipotle is clearly doing well, their stock is actually more appealing to these big-time investors now than it was a few months ago, even with all that growth.
You got it. It might seem counterintuitive, but that's the name of the game in value investing. It's not about chasing the highest growth no matter what. It's about finding those sweet spots where the price feels right based on the company's potential.
And what message do you think that sends?
I think it tells us that those in the know, those with the resources and the experience to really dig deep into the market, see something special in Chipotle. They see a company with a proven track record, strong fundamentals, and a future that's looking bright. And they're willing to bet on it, even if it's not the most glamorous or talked about stock on the market.
It's a good reminder that sometimes the best opportunities are the ones that aren't generating the most hype or grabbing all the headlines. It's about looking beyond the surface and finding value where others might not be looking.
Exactly. It's like finding a hidden gem in a sea of diamonds.
Yeah.
It might not be as flashy at first glance, but it's got its own unique sparkle.
I like that. And it highlights the importance of diversification.
So to recap, we have Nvidia, a bit of a Wall Street darling with impressive growth, but facing some big questions about its valuation. And then we have Chipotle, quietly and steadily growing, delivering solid results, and potentially undervalued despite its success.
Two very different companies, both at critical points in their journeys, offering valuable lessons for investors of all levels.
Which brings us to the heart of it all. What can we, as individuals, learn from all of this? What can we take away from these Wall Street giants and their investment strategies?
That's what we're here to uncover. Stay tuned, because when we come back, we're diving into the key takeaways from this Nvidia Chipotle story. And more importantly, we'll discuss what it means for your own investment journey. Don't go anywhere.
And we're back, ready to dig into those key takeaways from this whole Nvidia Chipotle saga. You know, it's got me thinking, though.
What's that?
These moves by these big-time investors, they might be hinting at something even bigger than just, two companies.
You might be onto something there.
Okay, so what's the bigger picture then?
I think we could be seeing a shift away from this growth at any cost mindset that's been so prevalent in the market lately, especially in the tech world.
Yeah, it seems like investors are starting to ask some tougher questions about those sky-high valuations, looking for more than just hype.
Exactly. They want to see those concrete signs of long-term success and stability.
So it's not enough for a company to just be growing super fast anymore. Investors are getting pickier, huh?
It's like they've been burned before, and now they're bringing their fire extinguishers.
I like that analogy. So while everyone's busy chasing the next big AI thing, some savvy investors are realizing the potential of a less hyped, but solid opportunity, like, a well-managed, fast-growing restaurant chain.
Right. It's like finding a $20 bill on the sidewalk while everyone else is busy digging for gold.
And hey, sometimes that $20 is a sure thing.
Exactly. But look, this doesn't mean tech is dead or that AI is a fad. It's a reminder that market trends are cyclical. What's hot today might cool down tomorrow, and vice versa.
That's such a crucial point. It's all about adapting to the ever-changing market and understanding that diversification is key.
Couldn't agree more. Having a balanced portfolio that aligns with your own risk tolerance, your financial goals, your investment timeline, that's essential.
Okay, so let's bring it all home for our listeners. What
Yeah.
can they actually do with these insights? How can they apply this to their own investment journey?
Well, first things first, remember that what works for a billionaire hedge fund manager with a team of analysts might not be the right move for, someone just starting out.
Right. Don't try to be someone you're not.
Exactly. Find what works best for your individual situation, your goals, your risk tolerance. Second, and this is huge, don't be afraid to go against the grain.
So you're not saying everyone should run out and buy Chipotle stock, are you?
Not necessarily, but what I am saying is do your own research. Don't just follow the herd. Question those assumptions. Consider different viewpoints. Just because everyone's excited about something doesn't mean it's the right fit for you.
I love that.
Yeah.
Think for yourself, do your homework, and trust your instincts.
Exactly. And finally, always remember, investing is a marathon, not a sprint.
It's about building long-term wealth, not just chasing those quick wins.
Precisely. Think long-term, be patient, and stay informed.
This has been an incredible deep dive, as always, but before we go, I want to leave our listeners with one last thought. We've been talking about how these recent investments might signal a market shift, a move away from just chasing growth towards a more value-driven approach. But what if it's even bigger than that? What if it's a fundamental change in how we value companies and their long-term potential? Is this a blip on the radar or the start of a whole new chapter in investing?
Now that's the million-dollar question, isn't it? And it's one that investors at all levels will be wrestling with for years to come.
And on that note, we'll leave you to ponder that thought-provoking question. Remember this deep dive. It's just the beginning of your exploration. Keep those questions coming, keep learning, and most importantly, keep investing in your financial future.
Until next time.